So before we get started with the question, I'd like to ask our panelists to introduce themselves. Aaron is from Atrium, and I'll let him explain a little bit what they do. And Russ is from DocSend, and you might be able to guess what his company does. Some people make jokes about how we how we name services at AWS. DocSend is very clear. So if you folks would just like to say who you are, a little bit about the companies you represent, and then we'll get started.
My name's Aaron Terwey. I'm an attorney at Atrium. Atrium's a relatively new law firm representing startups in the Bay Area, founded by Justin Kahn and some big firm attorneys, and we are constantly growing and represent a good chunk of startups.
Cool. Russ Heddleston, co-founder and CEO at DocSend. We get jokes at career fairs. People walk up, they're pre-med, and I didn't realize why they were doing this at first. Then we realized they thought we were sending doctors around, and we send documents instead. So we joke that the doctors they complain too much, so we switched to documents. But we're a way to send and track secure documents, e-sign, get NDA signed. And yeah, we're located in San Francisco. The company's raised 4 rounds of funding. This is my second startup as well. The first startup just had a seed round, and then we sold it to Facebook as a talent acquisition, and then started DocSend 6 years ago. So,
excellent. How many of the people in the audience, raise your hand if you've never received a term sheet, if you've never directly worked with one? Okay, good. So we've got a good mix of people at the end. So when we were preparing for this, Aaron was, I'm not going to ask him to name an exact number. We were joking about this before, but Aaron was telling us he's been working in this space for a while. He has dealt with more term sheets than probably anybody in this room will have seen in their lifetime. So to start with, along the kind of the anatomy theme, can you tell us, what is a term sheet? What are the various constructs? And by the way, you're also going to get 2 sample term sheets that are sent to you after the event. But tell us the anatomy. What goes into a term sheet? What is the purpose of one?
Yeah, so the term sheet, at its most basic elements is the terms that a founder and the investor have discussed and negotiated in terms of financing. And so it's not going to be, it's not going to have everything that goes into a financing, because otherwise, lawyers would have a lot less to do. Instead, when you're raising, for example, a Series A, they're going to be sort of 5 core documents, and together that's probably 100 to 150 pages. So a term sheet is meant to sort of take what can easily be distilled into a couple of pages and just sort of summarize what the parties have agreed upon. And so, you talk about valuation, liquidation preference, director rights, all sorts of protective provisions and that sort of stuff, and basically just boil down the essential terms of the deal into a document.
Okay. So Russ, can you talk about your so where you are with DocSend now? Can you talk about your fundraising experience, and also how did you first get educated on where term sheets fitted in?
Yeah, great question. It's not something there's not a lot of knowledge about it out there, and so you just kind of figure it out as you go. But so the first company I started, Pursuit, we did a convertible note, so that's kind of a do-it-yourself setup, which we might talk more about. And then for DocSend, we raised a seed round of 1.7 million from Uncork, whose party I'm missing tonight. So, but they've been great investors. And then we raised a Series A from August Capital. We also, in between that, raised a round of venture debt from WTI, and then we raised another round in December that we haven't announced yet. But yes, there are a bunch of term sheets. They're all very different. Part of it's Googling it, and part of it's just running around asking friends who have been through it before. And it is often very hard to know what is standard and what is okay, and because it's just not a thing that people talk about a lot. I will also say, in terms of what is a term sheet, it's if you're in the fundraising process, you're just so excited to get a term sheet. You're like, oh my gosh, I've done it. And then the answer is hopefully, but also there's a bunch of other stuff to think about now too.
So it's interesting talking about the excitement. Some of it, there's the term people would say that if I had more time, I would write you a shorter letter. How, given that certainly we hear from many early stage founders, raising money is a really important thing for them. They've got to be able to pay people. They've got to be able to do things. So there's a kind of a get it done kind of thing. How important? How much time should you kind of disproportionately? And I'll ask both of you to answer this. Should you kind of disproportionately invest in in getting the first one right? We talk at Amazon a lot about one-way doors. Are we going to go through a door that's going to be very difficult to get back from? Does that analogy apply to term sheets? And particularly, can you make some really bad decisions with the first one that then will be difficult to unwind?
I guess I'll start and say, as a founder, when you're about to embark on this process of raising money, I would advise that you first sort of sit down and sort of think about what your dream financing looks like, and write down all the things that you definitely want, and then also probably more importantly, all the things that you definitely don't want, and that will sort of help you. It's very exciting when you get a term sheet, and especially if it's the first term sheet you've received, and you might feel a sense of duty or obligation to work really hard to make that term sheet work for you. But I think the best thing you can do is sort of take your time. There might be some deadlines in the term sheet saying that if the term sheet's not accepted by XYZ date, then it's no longer a valid term sheet. In my experience, investors, if they're willing to send you a term sheet, they are willing to sort of lengthen that window, and especially if it's the first term sheet you received, because they know that you want to go through the process and make sure you've done your due diligence.
Mm-hmm. Yeah, definitely. I think there's a whole bunch of process that comes around getting a term sheet, and it's about the pitching, it's about your relationship with the investor, and it's something if you get married, you can get divorced. If you take a round of financing, you actually can't. There's no mechanism to break up with that investor, so you're really in it to win it with them. So I think a lot of times people will over-focus on just the general term, like the valuation and the amount raised, and that's like the TechCrunch headline. In my opinion, what I care about a lot more is just the cleanliness of the terms and how they define our working relationship with each other and what rights I get, and I get to keep as the entrepreneur. So that's what I usually focus on.
And did you learn, over the course of your time, did you learn that through a bad experience? Is there a specific example you'd care to share? Learn from?
Well, I personally haven't had any bad experiences, but in talking to a lot of other entrepreneur friends, hearing their horror stories, a lot of times it'll come up not in the financing, but if you're trying to sell your company, for instance. And then the term sheet governs who gets which rights. The term sheet will also govern things like liquidation preference, which is not something that entrepreneurs think a whole lot about. And depending on what rights you have and what rights the preferred owners have, they might be able to block a sale of your company. Or if you're trying to raise another round of money and you don't have you're running out of runway, existing investors will sometimes block that if they have the rights to that, in order to hold out or get more equity in the company. So you can see some really bad behavior that happens, and the first thing is you need to make sure you like your investors and you do your reference checks on them. But the second thing is I don't think there's a good reason to expose yourself to more risk than you need to as an entrepreneur.
Got it. And Aaron, can you give some examples of some specific things that people wouldn't? You talked about in generalities about undesirable things. Could you talk about some specific things and then the impact that they might have?
Yeah, so there are, for better or worse, there is a sort of set of terms that are sort of generally accepted or common in Silicon Valley for example, raising a Series A. And so, when evaluating a term sheet, if a client sends me a term sheet and says, hey, here's something I received from a potential lead investor, it's easy for me to go and look for the red flags. And so the red flags that I typically look for are, liquidation preference. If it's 1x non-participating, that's great. That's pretty much standard. If the required or available option pool is too large, it's not a deal breaker, but that's just something that we'll want to push back on. Board control, if it looks like it's pushing for too much control for the investor on the board, then that's going to raise some eyebrows. It's just, I think, without being too self-serving, the best thing you can do is have an experienced venture attorney who has seen a lot of term sheets, you can send your term sheet to and say, hey, does this pass the smell test?
Okay. Who in the room feels completely comfortable with what liquidation preference is? I could invite someone to come up, but that would be unfair. So I'm going to ask Aaron. Could you tell us some more? Because I think this is a term I certainly know when I was very naive when I founded my startup. So I'd love to know, and I'm sure some other people here would.
So liquidation preference is the amount of money that your investors get before your common shareholders get anything. And common shareholders are going to be the founders and the employees, typically. Liquidation preference, when you're saying, when you're throwing around terms like 1x non-participating, basically you take the 1x, that's one sort of scope, and then the participating or non-participating the other. 1x just says how much of the investor's original investment do they get back before the common takes anything. So if it's 1x, they get their initial investment back. If it's 1.5x, they get 1.5 their initial investment back before the common takes. In terms of the participating versus non-participating, the easiest way I've found to explain it is participating is basically getting 2 bites at the apple or double dipping. Participating means the preferred get their liquidation preference, their 1x or their 1.5x or whatever, and then they share pro rata with common as if they were common holders. Non-participating, which is more standard, is downside protection. It is if there's enough in a liquidation for the investor to get their 1x back, and then there's more to go to common, basically, let me walk that back a minute. Basically, if you weigh the two, if 1x would get them more money, then they get the 1x. If participating pro rata with common would get them more money, then they share with the common. So that's the downside protection. And so, the participating versus non-participating is just double dipping or downside protection.
Yeah, maybe a simple example can help, because there is a good reason to have a 1x liquidation preference in the term sheet for the investor. So let's say you raise a $10 million round of funding and it's a $50 million post-money valuation. If you were to turn around and then sell that company for only $30 million, they would actually they just lost money on that deal. So it's kind of saying, I'm going to get my $10 million back as an investor, and if it's huge and we sell it for hundreds of millions, then everyone's happy, but it's downside protection. And if you're doing the double dipping thing, if it's participating preferred, or it's like a 2x liquidation preference, and as an entrepreneur, we're all very enthusiastic, it's going to be awesome, but let's just say you're a $50 million company, you're only able to sell it maybe for like $20 million or something in a few years, doesn't quite go according to plan. If there's a 2x liquidation preference, that means all 20 million would go to the investor. So as an entrepreneur, so that's when you say when a common is wiped out. There's actually no reason for you to sell that business. It's just, you might as well not even try. And so you can get yourself into some tough spots.
And to follow up, one of the things you'd said before is some people would get really excited about a higher valuation for the kind of the press they might get. Is there a connection there that high valuation might be connected to some rights that are not so good for the entrepreneur?
Well, you've probably seen more of these, but yeah, I've been a mentor in StartX for a number of years as well, and have done some investing. And other people I've talked to where they have multiple term sheets, it's not necessarily always best to take the highest valuation or even the most money. And so if, for instance, you push back on a term sheet and they have participating preferred in there, but someone else is giving you less money, lower valuation, but without that participating preferred, it signals to you that the first investor maybe doesn't have your best interests at heart, but is willing to pay up a lot for the deal. But maybe that's not the right person for you to be working with in the long term, because you really want to be aligned with them.
Right, and to play that out in your example, that could mean that with the higher value, the thing that looked optically better to someone who's naive, a couple of years down, if things don't work out so well, it's less good for the entrepreneur.
Right, or they might be doing other things that aren't in your best interest. So yeah, it's just not always about the total amount of money you're raising. Yeah.
And I would say, when sort of comparing term sheets, take the old college admissions approach, which is look at them holistically. They're going to have different terms. Valuation might be more favorable on one term sheet, but board control might be more favorable on another. But you really just have to sort of sit down and look at all of the terms and weigh them in terms of importance to you. And at the end of the day, like Russ said, you might take a lower valuation because you get to hold on to the control of the company longer, and that might be more valuable to you than a higher valuation.
Okay. One of the concepts you mentioned in your answer was, I think, you were talking about preferred stock. Mm-hmm. So one of the questions we had is, what is the difference between common stock and preferred?
Yeah. Common stock is just your plain vanilla stock. It's what typically the founders have, the employees have, and that is just your basic everyday. I own 1 share of this company. This entitles me to X percentage of the company. Preferred, there is no sort of when somebody says, well, what preferences do I get? Well, the preferences for a class or a series of preferred stock are negotiated. It's whatever the company and the investors negotiate to be the preferences of that preferred stock. So when we're looking at the preferences that go into making preferred stock, liquidation preference, ability to appoint board seats, protective provisions, a dividend. Those are the sort of components that go into making preferred stock be preferred.
Okay. Is there any, so you talked about common terms that you might come across in Silicon Valley. Are there any kind of, clearly one option for an entrepreneur who might be super deep in the technology that they're working on but may not be a legal expert. Clearly one option is they can go and find a legal expert. How bespoke are term sheets? Are there any kind of industry standards or some kind of thing I could at least compare something to as a starting point?
Yeah, so I think it's pretty common, not only in Silicon Valley but across the U.S. for venture capital deals, especially sort of Series A or sort of a heavy Series Seed, to use documents at least that are in part crafted from the NVCA form. So the National Venture Capital Association promulgates a set of forms, and those are the forms that I think most law firms use as their baseline for drafting these documents. I would tell you to go look at these documents because the NVCA has them up on their website. You can get them for free. They are heavily footnoted. I don't think they are. They're not entertaining to me, and I think they're written for me. So I would not advise you guys to go get deep into the footnotes. But it does a very good job of explaining everything, and for a lot of things that there's a lot of optionality in the documents, and explains sort of why it's that way. But yeah, for Series A and later, it's NVCA documents.
Okay, but they are still a baseline. So presumably the things that Russ was talking about, those challenges could still exist beyond that baseline.
Right. Yeah. So there is, like I mentioned, there's a lot of optionality in the documents. They include bracketed language, do it this way or that way. But that's really the optionality in the NVCA documents is really more of a legal sort of negotiating playground. In terms of sort of the key points of the deal, those are going to be negotiated between the founder and the investor. When we're talking about valuation, we're talking about board control, or we're talking about protective provisions. Those are all things that really I can provide guidance in terms of what I see on a regular basis. But at the end of the day, it goes back to what the parties are comfortable with.
Got it. And then Russ, from your experience of the people that you mentor, why do people end up in bad situations? Do they just not ask the right advice? Do they towards you? And again, for anyone who hasn't raised money, it's the first time experience. Do they tend to be scared that it's like the exploding term sheet, that if they don't accept it, it's going to go? What leads to people going through the doors that they wouldn't want to go through?
Yeah, that's a great question. I do think a lot of it comes down to the psychology of the situation. So if you're running your company, if you're bootstrapping it and you're putting it on your own credit card, you're pretty stressed about money, you're raising a seed round, and you're just happy to have an institutional investor who's willing to work with you, which is great. Same at the Series A, if you start spending your Series Seed money, so you've got burn rate and runway, and you just it's like a ticking time bomb, and then you're out of money and you're done. So you have to time it right to go through that process of going and pitching VCs, and hopefully getting multiple term sheets at the end to make sure it's a good market rate deal. But you're still on a very thin line there. And so, yeah, when you get that term sheet, a lot of people aren't sure what they can ask about, what they can push back on. I do think it helps to have good legal counsel where they can, say, actually, we do need to push back on this, or like, that's not standard. And there is some cultural element to it as well. Different firms have reputations for different terms. And also there are some cultural differences, even just with like East Coast investors who are more traditional, like private equity or like hedge fund background people, and what they think is okay to put in terms. And so you just, as an entrepreneur, really need to stop at that point in time and like read through it and look at it holistically. And yeah, as Aaron was saying, if a VC takes the time to send you a term sheet, they're also going to take the time to walk through it, make it a negotiation, make it a discussion about what you want your working relationship to be like.
And presumably if they don't, that would be a signal to you to walk away from them.
Yeah. And there are a lot of negotiating tactics here too. Like it's not necessarily always the case that the entrepreneur and the VC are very aligned, and this term sheet process is one of those where you are negotiating against each other, and then you're going to go work together for a long period of time, but you need to negotiate. So the investor is motivated to get better deals for them, better terms for them. There's also the dynamic within a partnership where a partner is sponsoring this deal. They had to get it through their own investment committee, and maybe that investment committee is asking them to put things in the term sheet, or maybe, especially if they're earlier in their career, they might be self-conscious about that. They want to get a really good deal to show the partnership they can. So there are a lot of different dynamics that can be playing out that when you get the thing, you might not even be aware of.
Right. So, Aaron, I'm going to ask you what might seem like a very obvious question for the lawyer, but I think it's an important one for the entrepreneurs.
I like easy questions.
Well, it might not be.
Oh no. Okay.
But it's like, do you find that some entrepreneurs tend to leave it too late? Like when they think of involvement with legal advice, do they tend, in this kind of panicky mode of, I've got this thing, do they tend to leave it too late and think that we need to get someone to look at this legally at the end? Is that one reason they end up in these bad situations?
Yeah, so I think a lot of it has to do with, as Russ mentioned, sort of running out of runway. If you are going out and raising money when you're getting close to being out of money, then you might not want to get it. You might feel that you don't want to get an attorney involved until you sort of have a sure thing, because traditional law firms bill by the hour. So if you send a term sheet, it's going to rack up charges, and if it's not a sure thing, then you're worried about that. I will plug Atrium and say, we don't bill by the hour. We do everything on a flat fee basis. So if you engage us for a capital raise, it's all included. And so send us as many term sheets as you want, because we'll look at them and help you weigh them. But I will say, get your attorney involved early on, and just because they will help you walk through this, and they'll help you strategize about, okay, well, we have this term sheet. We think it's a good term sheet, but we also said we're going to give ourselves 15 days to collect all the term sheets. So let's, and if the deadline on this term sheet isn't for 15 days, we don't have to respond right away. So let's be strategic about it. But yeah, there is, I think, especially among sort of first-time founders, there's maybe a feeling like you have to respond right away to the term sheet, and not even have time to involve your lawyer. There's always time.
And does that jive with what you see with people you mentor, Russ, that they tend to make those mistakes?
They just wait too late to get a lawyer involved. Yeah, that's part of it. Part of it's also process. So Aaron, as you were saying, like we said, we're going to have 15 days, whether it's your lawyer or a mentor or an advisor or something. It is very important to have a process when you go out to fundraise, because that allows you to put a stake in the ground. And one tactic that some investors will use is they'll try to preempt the round. So they'll try to get in there and like invest early so that it's not a competitive deal. And then they'll try to tell you, well, you had to take this term sheet or I'm walking away. So using pressure tactics like that is not necessarily great. And so if you just say, these are the 2 weeks we're going to be fundraising, I'm going to have all my conversations in that period, and then I will decide by this date. And that's the date, and that's the process. And so that'll give you time, and you won't feel like you're kind of on the defensive.
Okay. One of the things you mentioned before, I think it was you, Aaron, I think it was you, might have been Russ, who said, you can get divorced, although no one wants to get divorced, it's kind of challenging to walk away from that. One of the things that I think is definitely from founders I've talked to is really common is when founders might divorce, and clearly that's something that's going to happen. The startup I co-founded, my co-founder was our investor. that was a foolish thing. Don't be like me. Don't be that kind of fool. But what kind of thing are the things that people should think of specifically for that kind of outcome, where the person you started this thing with, for whatever reason, has to walk? I'll ask both of you.
Yeah. Well, that actually is a common term that shows up in term sheets, which is around revesting founder shares. And there can be good reasons for that. The way you do it is actually important. So if you want the stock to be QSBS eligible, which is another thing to talk about, then it has to be given outright. But yeah, revesting shares over time can actually be a good way to make it fair if one of the founders ends up leaving within some period of time. They don't get as much equity in the business. And if they just had it, I think Zipcar had a kind of very notorious example where one of the founders had left very early on in the company but still got all their shares. And so, yeah, that can be one tactic to help with that. Or were you asking more about just the relationship side of that?
Well, we could talk about both. I mean, I think I was asking about the technical thing. I'd love to know, Aaron, whether this, well, I guess two things. One, whether this is something you see. And then the second thing about the relationship is that presumably this is the same kind of thing as people, you know, if you're going to get married to someone, you probably don't want to talk about the bad outcome at the start. I know for me personally that the breakdown of my relationship with my co-founder was very unpleasant. And now, obviously, I'm older and wiser and would not make the same. I will continue to make errors. Hopefully I won't make that one again. Do you see this, is this a common thing? Do people, I mean, sometimes do people just not want to talk about this kind of obviously quite common bad outcome, but like a psychologically nasty one?
Yeah, I mean, I think, you know, as the attorney for the company, I will always say, get everything in writing early on. Everybody's happy and everybody thinks that the company is going to, you know, take off. Because, you know, there are a lot of times where it doesn't. And you know, you don't want to have these negotiations during a breakup. It's better to get it sort of papered up early on. But yeah, you know, Russ mentioned sort of founder vesting and founder revesting. You know, there is sometimes a tendency for founders to say, well, I founded this company, this is my idea. You know, the founder shouldn't have to vest their stock. Well, everybody should vest their stock, even the founders, just because, you know, you don't want to wind up in a situation where a co-founder leaves and walks away with, you know, a third of the company. It's going to be really hard to raise money with that sort of dead weight on your cap table.
And when you say vest the stocks, they've got to be on the same schedule as other people.
Right. So in the Bay Area, typical vesting schedule for startups is 4-year vesting with a 1-year cliff. What that means basically is you have to be there for a year for anything to vest, and at that 1-year mark, 25% vests, and then the remaining 75% vests monthly over the next 36 months.
And and if you don't get this right the first time for this particular founder divorce thing, how different? I mean, is this is this a one-way door kind of thing, or is it?
It can be very messy. Yeah, it is. It is one of those things where, you know, you'd like to think that, you know, given the relationship between the founders, you know, the departing founder, or, you know, the departing founder won't make it painful, but you know, emotions get the best of people, and it can be as bad as any divorce.
Okay, well, sliding to safety with an awful pun. How about founders deciding between a safe and a convertible note? Could you tell us about those?
Yeah. So I think, again, in the Bay Area, the most widely accepted way to raise seed money is with a safe. You know, SAFE stands for Simple Agreement for Future Equity. It's a document that was introduced by Y Combinator, sort of to replace the convertible note, just because the convertible note has, you know, some additional terms to negotiate, and you know, it's not as simple to do as a SAFE. And SAFEs are, I think, here by far and away the most common way to raise seed money.
Okay, and what is a convertible note for those?
Yeah, convertible note is, you know, I think we're all sort of familiar with typical debt instruments. You know, hey, you're loaning me, you know, $1 million. I promise to either repay this $1 million with interest, or in the case of a convertible note, convert the $1 million plus interest into equity of the company at the next round, at the next equity round.
So would you expect, so for a majority of first-time founders in this room in the Bay Area, would you expect them to be offered safes?
Yeah.
in the first instance.
Yeah, and you know what I would say is the founders will be offering the safes. You know, I think having a plan of how you want to raise your seed round, and then you go to investors and you say, you know, hey, we're raising our seed round with safes, and you know, sort of don't give the investors the option to give you a convertible note. I don't think most of them would, but you know, why pay interest when you don't have to?
Got it. But that's the thing, they should ask if they were presented with a convertible note, they should. Is that a warning sign for people? Or
I don't think it's a warning sign. You know, I think you know, if they do give you a convertible note, it'd be interesting to see sort of who the investor is. You know, if it's, you know, before I moved out here, I practiced law in Texas, and in Dallas, convertible notes are still the norm, just because I think it takes a while for things to filter out there. Plus, in Dallas, you're dealing with a lot of real estate and oil and gas people who, you know, they know debt instruments. They don't know what a simple agreement for future equity is, and so. But in the Bay Area, safes. I wouldn't say a convertible note is a warning sign, but you know, having context on who your investor is will help you figure out if that should be a warning sign.
So talking of investors, Russ, then let's ask you this question: what did you do when you were fundraising? When you were thinking about working with investors, what kind of work did you do to try and find out who was good for you?
Well, it really depends on the round as well, and there are a lot of factors. One of the things is, even ahead of who you're going to work with, let's just say for your seed round, you actually have the choice of, do I go the safe route or do I go with an institutional route? And this is DocSend is also interesting because it gets used for a lot of VC pitch decks, so all the entrepreneurs send it around. So we actually have a fair amount of data, and we asked a bunch of founders to participate in some research we did, and one of the things that we were able to see was how big our kind of angel-led rounds, which would be like a safe note, and then how big our seed rounds where an institutional is involved. And by and large, if you raise from a seed, seed fund, so like Uncork or a seed investor, if you're able to do that, you'll raise more money faster, and they usually take half the round, and you can fill out the other half of the round. And if you are just kind of doing an angel round where you're just, you know, getting a bunch of people to sign safe notes, you still have to get critical mass, which can be hard, and you still have to find a lead investor. So the very first time I did fundraising was for Pursuit, and yeah, at that point it was just convertible notes that we did, and we got a whole bunch of people to sign up, but it was a really long kind of process. And then for DocSend for the seed round, I'd done this research on a bunch of investors. I'd say the right way to do that, or at least the way I did it, was to just run around and talk to other founders who were further along in their companies, especially founders who didn't have good outcomes to their companies, just to get a sense for like which investors they like and would recommend. So I made a list, and then we kind of went through and pitched them all, and Uncork gave us the term sheet, and it actually was like very fast. And we also had a lot of people who wanted to join. You'll find that a lot of, let's just say there are a couple of angels you really want to work with in your seed round, they will definitely just join whatever terms the seed fund sets for you. So then you don't need to deal with it, which is actually very convenient.
And I would add to that, you know, if you're at the point where you're getting term sheets from investors, you know, ask investors for references. Ask them for founders that they have worked with, and call those founders and ask them, because you know, more than just the money that the investors are putting in, you want to make sure that it's a good fit for, you know, in terms of, are they going to be a good partner in both, you know, when times are good and when times aren't so good.
And on that, Russ, I mean, I'm definitely not asking you to share names, but were there any kind of obvious red flags you would share with this audience for things that made you decide you didn't want to work with particular investors, or can you kind of characterize the type of things that would set off your spidey sense, or how would you like to phrase it?
Yeah, well, one thing, yeah, but definitely can't share any names, but you know, in doing a reference check on one, found out that he had actually pulled a term sheet on an entrepreneur, which was a big red flag for me. That shouldn't be something you do unless there's like something egregious that you find. And so the reason it is a red flag is that it's, in my mind, just not a great negotiation tactic. So let's say you get the term sheet from an investor, you negotiate it, you're like finalized, then there's a period of time where they're doing diligence before closing. And they're only supposed to be able to back out if they find something that's just like really awful, that you misrepresented your business. But if they decide to like pull that back later or like start the negotiation over again, they're hoping that you are just more desperate at that point in time. Like you've got less runway, you've already scared off the other investors, and so that, you know, like, I heard the story about someone. I was like, that's fine. We'll find someone else. And you do hear these stories occasionally. And so it is good to actually do the references, and then also do references that they don't give you. Try to find other people who they've worked with in the past that aren't on their list of references.
And so for you, Aaron, I mean, how often do you, so one of the audience questions we had was exactly around that, Russ. It was, can investors back out of a term sheet? Sounds like it's rare. What is your experience? So first of all, when is there really a point of no return for them? Does it happen frequently?
It doesn't.
Do you see more?
Yeah, it doesn't happen frequently. I would say, I think what we've sort of, the percentage that we've seen is once you have a signed term sheet, there's about a 95% close rate. That deal is going to close 95% of the time. And the 5% of the time where it doesn't close usually has to do with, you know, the investor has gotten into the data room and found something that, you know, maybe wasn't as promised. And we're not talking about sort of minor things. We're talking about, you know, hey, we said we had $5 million in revenue last year, but we really only had one. You know, when it's sort of a material misrepresentation or omission or something like that, you know, if you know the company is in the process of being sued for, you know, intellectual property issues, then that's going to be, if you're an IP dependent company, that's going to be a major issue. So you know, fortunately, I have not had that situation arise, but yeah, you're looking at about a 95% close rate from a signed term sheet.
Got it. One question we're going to talk about is boards of directors. So I'll ask both of you to talk about it in turn. What would you see in a term sheet related to boards?
Yeah, I think at the Series A level, you know, after the Series A round, the founders typically still control the board. At that point, we're looking at either a 3-person board with 2 founder directors and 1 Series A director. Sometimes we'll see a 5-person board. You know, typically we're looking at 2 or 3 founders, 1 or 2 investor directors, and then maybe an independent.
Okay. Are there any things that, Russ, you would give, you learn the hard way, or people you meant to have learned advice that you would give related to boards?
There's no like learned it the hard way advice that I can think of. One of the things I'm very happy we did was at the seed round of funding for DocSend, you know, we had the option of do we want to have a board or not. And my thought process around that was Jeff Clavier from Uncork. He's just a really experienced investor and has been around for a really long time. So I thought there's a real benefit to me, the entrepreneur, to have more of his time. And so to have a board and put that in place. Sometimes entrepreneurs don't want to have a board at the seed round. It also helps de-risk your next round of funding if you do a Series A later. Having that cadence of board meetings just makes you look a lot more put together. And it signals to the investor that, you know, when they're digging through the data room or they're going through diligence, that everything is going to be as it should be. And so, yeah, I'm very happy that we put together a board at the seed round. And then at the A round, we expanded the board. Instead of, because sometimes you can have your Series A board member just replace your Series C board member. In our case, I actually like working with both of them. From August Capital, it's Howard Hartenbaum, who's been awesome to work with. And so then we expanded it to a 5-person board, 2 founders, 2 investors, and then 1 independent. And an independent board member can be a really great way to get someone involved who you really want them involved. They could be an advisor, but having them be an independent board member, you're just going to get a lot more of their time, and it can be a really good way to bring some outside expertise into the company that you might not be able to hire someone at that caliber yet.
And then how do you, I'll ask both of you this, how, from a kind of a leveraging and pushing for that, how does that tend to work? Because obviously one of the nightmare scenarios for some founders is they find, you know, they lose control of the company later on. Where does leverage fit for pushing for how many seats on the board, or making sure that they protect their position?
We never had much negotiation around that, just because there are some industry standard things with it, where it's it's seed, one investor, two founders, or a founder director, and then if you go to a 5-person board, having it be 2 investors, 2 people from the company, and 1 independent is just a really fair way to go. And so I didn't see any reason to push back on that or ask to have like 3 founder board seats at that point in time.
What I would say is, if you're going from, a situation where maybe you didn't give up a board seat in your seed round, so, maybe you don't officially have a board yet, and you're raising a Series A, and if the investor maybe is asking for 2 board seats, so now, in order to keep the founders in control of the board, you're going to have to expand to 5. It's not unheard of, but it's a big jump to go from no formal board to 5 board members, and so you can get into this situation where you got too many cooks in the kitchen. So I would say if you're facing that sort of demand from an investor that they want to have 2 board seats, I would sort of take a step back and say, well, look, we've gotten the company to where we are today with no formal board, and we're at a point where you feel comfortable enough to invest, and you can work out a situation where maybe they get a board seat and an observer seat. So an observer seat is not an official board member, but it's somebody who's at all the board meetings and has a say in the room. But when it comes to official board votes, they don't have a vote.
Got it. And did I hear something in you saying of not giving away a seat in the seed round? I mean, is that one of these things that you collectively would think is a best practice, you guys, or not?
I think it all depends on sort of how you feel. In Russ's situation, he wanted his lead investor in the seed round to have a board seat, and I think if you have that kind of relationship, that's great. It's one of those things where if you think that the board member or a seed stage board member can help grow the company, then by all means. But if you think it's going to not be a great relationship, I would first say, well, why are you having that person invest in your company? Second of all, if they're not asking for a board seat, don't give it to them.
You got anything on this?
So the board has some control, and then preferred also has some control, and this is also something that can be negotiated, where instead of it is up to a board vote, it's up to a vote of preferred shares. So that can be one of the other rights that will make preferred more valuable. So for instance, like DocSend, like the founder, like my salary is like based on board vote, but some other items are just up to preferred, like a dividend or a stock buyback. Or like M&A is actually preferred voting on it and not the board.
Those are the protective provisions that I mentioned a couple of times. That is, there are certain things that the company cannot do unless it receives a majority of the preferred vote, and those are what Russ is talking about.
Mm-hmm. Okay. I'll switch for a few minutes to some of the questions that we've had from our audience, which are a range of different ones. So first of all, here's one with an interesting term I don't know about. What's a ratchet or full ratchet, and are these acceptable in modern term sheets?
Ratchet or full ratchet is talking about anti-dilution. And sort of to simply answer the question, no. Full ratchet or anything other than broad-based weighted average is uncommon. So broad-based weighted average is what, I can't think of the last deal that I did where there was an anti-dilution provision that wasn't broad-based weighted average. And without getting into the math, because I'm an attorney and I don't really do math, but I will say that broad-based weighted average basically provides for the preferred to be able to convert into more shares of common than just a 1-to-1 ratio in the event that the company sells stock for less than the price per share paid by the investors. There are obviously lots of carve-outs, and it's when I say broad-based weighted average, it's a weighting formula. So it's not just did you sell one share at less than the Series A price. It's well, how many shares did you sell at this lower price, and how many shares would that total price have purchased if we had sold it at the Series A price? And it's a whole math calculation.
Okay, one kind of follow-up to I think one of the points you were making, Russ. So I think both of you should opine on this. And one might be, you don't need to worry about this, but the question was, how do you keep your first term sheet offer I guess this applies to any, warm while you're collecting others? And how do you avoid the situation where you get an exploding offer? Or, per the conversation, is an exploding offer really a real thing in the main, or is it something that people are scared of?
I mean, I think people do make exploding offers. It's an argument the investor does try to make to say, like, I'm going to walk away on this date. And to some degree, as the entrepreneur, you just have to have enough faith to say, like, in fact, no. If it explodes in this date and you don't want to work together, fine. But it helps if you can reference expectations you've already set in the past. So you can say, as we talked about, I'm not making a decision for another 2 weeks. This is the date I gave you. You're not conforming to my process. So if you can own the process more, you can avoid some of these types of situations. But you know, if your company's going really well, people will definitely try to preempt you, give you term sheets like outside of your fundraising process as a way to get a better price or to keep it from being bid up. But yeah, just you have to have some backbone and just like push back, and that's okay.
Yeah, and I would say, you know, it goes to, you know, helping you determine if this is the kind of person that you want to work with on a long-term basis. If you have set the expectations and said, you know, hey, you know, we're collecting term sheets and we're going to make a decision by X date, and the investor gives you a term sheet that expires before that date, you know, first I would just gently remind them, say, hey, we talked about this. If they are adamant about having this exploding term sheet, then you know, it makes you sort of, you know, it goes back to the whole, you know, if they're going to send you a term sheet, obviously they like your business and they want to invest. So if they're sending you an exploding term sheet, it almost makes you sort of suspicious about what's in the term sheet that they want you to accept so quickly without doing your full due diligence.
And in reality, is it more often, is the majority case posturing when these are exploding term sheets, in your experience?
Yeah, I mean, I think it's a tool that investors use to sort of keep the conversation moving along. You know, obviously they have to have some expiration date in the term sheet. You don't want to send a term sheet out that just has no expiration date. But you know, reasonable expectations or reasonable expiration dates are appreciated, and you know, investors know that as a founder you're going to want to talk to, you know, your advisors, your co-founders, your attorneys, and make sure that, you know, the term sheet that you eventually decide to go with is the right choice for the company.
Got it. We talked about earlier some of the kind of the challenges with having a co-founder and some of the kind of split up things that might happen. One of our questions now is, actually, how important is it to have a co-founder? Does the advice change significantly for solo founders? Does it just make everything simpler?
I don't think it changes any of the advice I've given or things I've talked about. A more practical thing that will come up if you do have co-founders is just who is doing all the pitching and who is doing the negotiating, because you can't really negotiate by committee. That can be hard. But you really have to be on the same page as your co-founders. It is a risk if you're a solo founder going through fundraising, just, you know, because it depends on what stage you're at. If you make it to Series A and you're a solo founder, you're probably doing just fine. If it's seed stage and it's really just you and you've got an idea, like YC requires you to have a co-founder going through it. It can just be very helpful to have another person there to bounce ideas off of and do something like that. So it'll show up as more of a risk actually at the seed round.
Another question, should startup employees be able to know the term sheet conditions so that they would know what a liquidity event would be like for them?
No. You know, most term sheets have pretty strict confidentiality provisions. It's sort of a need-to-know basis, and if it's outside of the company, it usually requires getting written consent from the investor. Obviously, this has to do with an accepted term sheet. If you haven't signed the term sheet, you're not bound by the term sheet. But I would say, sort of for expectation setting within the company, you know, it's a need-to-know basis. You know, who knows what's going to happen during the financing process, and I think it can really hurt company morale if you know, you get a signed term sheet, you're going through the process, you tell your employees, hey, we're raising money, yay, and something happens and the deal doesn't close. That can hurt morale within the company. And so what I generally tell founders is, you know, wait until the deal's closed before you announce it, unless there's a reason why this person needs to know.
And then how would you handle it? I mean, if I was working at your, I certainly know from personal experience, this is a kind of a question for any employees who are paid in equity that isn't liquid. How do you approach it? I mean, if I joined your company and, you don't want to share the term sheet with me, but how do you, I guess the thing that's behind that question is kind of how would you have the conversation with your employees?
Right, if you're not going to share like the full term sheet, then like how do you talk about
valuation
with
exactly.
employees? Every company does something a little different around this, so I don't know if there is a one accepted best practice. There are varying levels of just transparency. If you're sharing even your revenue numbers with your employees, or you're sharing the post-money valuation of the last round, or you're sharing with them the total outstanding share number and therefore the percent that their equity accounts of the whole, so they can kind of go through and do that math around if the company is sold for this someday, how much would that be worth to me? There ends up just being a lot of trust between employees and founders, though. It can be helpful if the founder, there's like a repeat entrepreneur. You probably be more sure that the second time around they're being careful with being smart about fundraising and not getting themselves into a bad situation. But yeah, I haven't heard of any companies that share any of like the specifics within the term sheet. It's really more just around valuation, like company trajectory, and then even just explaining to the company like why we've raised and what it's for and why they're excited about it. I would definitely not recommend telling anyone at the company while you're going through the process, as you were saying. And by closed, we mean the money is in the bank. So even you sign the term sheet, you go through diligence, and then they wire the money, and then it shows up in your bank account. And then you can go and tell your company about it, and that's fine. But not before that. Even if it's only a 5% chance, it's not worth it.
And I guess a tongue-in-cheek related question. So after you get a term sheet signed, what should you be thinking of next? The kind of the nearest steakhouse, Ferrari dealership?
Man, I would say between term sheet signing and cash in the bank, the fundraising process is a series of sprints and marathons, and it's, once you have a signed term sheet, you really don't start celebrating until that cash is in the bank. And from my experience, on average in a Series A deal, term sheet to closing is about 45 days, give or take. So you've still got a lot to do between deciding the investor that you want to go with and getting the money.
So from the your decision point out of all of them. Okay, and then related to that, another question we had was we talked about exploding offers and kind of what is reasonable. What would a benchmark be for an expectation for making a decision?
I think that also varies a lot. I mean, you've seen more examples than I have, but for me, usually trying to get all the meetings into like a 2-week window. And my rule of thumb is for like seed or even Series A, if you pitch 30 investors and aren't able to get a term sheet, you should probably not pitch another 30. You should probably go change something about your business, make some more progress, like change your pitch deck around, something like that. That's probably a pretty clear signal from the market. And so the amount of time that it should take to pitch that many people, I think 2 weeks is pretty reasonable. And in order to get everyone sandwiched into like a 2-week time frame, you need to plan for that like a month ahead of time. So you need to because people are busy. You can't be like, I'm raising next week, do you have time? You pick a date a month out, get all those in a 2-week window, and then, partnerships are usually pretty quick at moving. And so you can, even when you're pitching, ask questions around what's your process for approving this investment? Is there a partner meeting? When does that partner meeting happen? How many people have to vote on this? Are you putting together an investment memo? And so then you kind of know what the timeline is. Like we meet every Monday. I'm going to take you to the partnership meeting next Monday, and then I'll be able to tell you by the end of day Tuesday. And so it's only going to take 3 or 4 weeks in total to hopefully get a term sheet and get it signed, and then another 45 days after that.
And some of that sounds actually like you might think through a sales process. It's like, what is the compelling event? What's happening in the company? Would you encourage entrepreneurs to kind of dive a little bit so that they're not just looking at this abstract, I don't know how long it's going to be kind of thing? Is there like a balance for how much you'd push to know you're meeting tomorrow?
Yeah, exactly. What's the next step? We've got to get this on the calendar.
Yeah.
It is similar to sales and also very dissimilar from sales from a process perspective. the pitch you give your customers, in my experience, is not the pitch at all you give investors. It is something entirely different, and it's on a much larger horizon, and it's a much loftier vision. And if you're trying to sell that to a customer, usually that's like too high and too in the cloud. So it is like an entirely different type of pitching. However, I do think it's good to be buttoned up on the process and ask these questions, and not be afraid to ask questions about people's decision-making criteria, because you do get a lot of maybes, which is really frustrating as an entrepreneur.
So we've got a few minutes left, so I'm going to ask you each one last different question. So for you, Aaron, can you, and this should be a shorter, succinct rather than a longer answer, but can you kind of give an interesting story of one of the biggest mistakes, or one of the most difficult things that you saw to unwind was?
Yeah, so I would say I am not one of those attorneys that thinks that every company and every startup needs to start from day one with an attorney. But as you get towards wanting to raise money, engage an attorney earlier on, just because one of the things that goes into making that 45-day window from term sheet signing to closing longer or shorter is, do you have all of your documents buttoned up? Without getting into details, if you are a heavily dependent technology company that has lots of engineers working for you, and you have not had any engineers sign confidential information and inventions assignment agreements, that's going to be a really big deal, especially if you've had engineers leave and they have created code for you, and now you might not have the rights to use that. So that is one of the toughest things is when we get a client that has come to us with either inexperienced prior counsel or no prior counsel, and they're facing either an exploding term sheet or running out of money. We need to get all of these things buttoned up, because the investor's attorney is going to come ask us for all of the things to be buttoned up before they'll put the money in.
Okay, that's good advice. If I leave Amazon again, not going to leave Amazon again, but if I do, I'm definitely going to talk to a lawyer early on. And then for you, Russ, I guess, is the as a an entrepreneur who's done this a few times now, if you could bubble it up to kind of one or two pieces of advice you'd want to give the people in the room who may be going through this, what would they be?
On the fundraising side?
Well, I kind of, maybe two, maybe one on the fundraising side and one specifically on the term sheet stuff. That if you were talking to a younger version of you now, a couple of things that you could, or a couple of areas that you would suggest they focus on.
Sure. Yeah. I mean, the first is just confidence. Like you just need to be very confident as you're going through it. Push back on things. Be inquisitive. Ask questions. There are some terms that are industry standard that still don't make sense to me. So you're not going to be able to push back and win on those things. Like, you, the entrepreneur, get to pay the legal fees for both sides. I don't know why that's the case. That is just the way it works. So figure out what areas you're not going to be able to push back on, and then be confident within that range. And then I would say for the fundraising process, it's just really tough to go through it because you can't talk with anyone else at your company about it. And so everyone who's going through fundraising, it's equally hard for everybody. And then what happens afterwards, if you successfully fundraise, you get that term sheet, it all makes sense, and then you close. From the outside, it looks really easy to everyone else, but while you're in the middle of it, it really seems quite murky. So the more you can do around having a good process and leaving yourself plenty of time. So I usually say it takes, leave 6 months. You've got 6 months of runway left. You should start the fundraising process now, because it's going to take you a while to put together your pitch deck, a month out, the meetings, the closing. If it falls through for some reason, you need 3 months to figure out how you're going to course correct or sell your company. So leave yourself plenty of time. A lot of the bad things I've seen happen are because people are just out of time.
Got it. So we're done with this part of the evening. We've got drinks. You've got a chance to mob these guys like the rock stars that we look like with these microphones on our heads. So Aaron, Russ, thank you for being great sports. Thanks for coming to talk to everybody, and I hope you enjoyed the event.
Thank you.